Okay, so welcome back to chapter 6, which is about depreciation and amortization. In chapter 6, we will look at depreciation of business property, depreciation of tangible personal property, depreciation of real property, and filling some forms and amortization of intangible property. So we have a lot of depreciation and amortization involved, which it's kind of common in a business, specifically if you have a client doing sole independent contractor and filing Schedule C, they might have some properties that they need to depreciate. There is overall two types of expenditure in a business. We have revenue expenditure and we have capital expenditure. Revenue expenditure means you spend money in order to run your daily business for the year, including utility expenses, let's say insurance expense, advertisement expense, fuel expense, maintenance expense. Those are all revenue expenditure, and you expense them immediately in that year. But there are some expenditures that you do today, but those are for fixed asset. And fixed asset, you don't expense them immediately because it's going to be capitalized. So we call it capital expenditure. Capital expenditure, that means you capitalize that asset that you purchased today, let's say building, and then you depreciate it down the road based on the useful life of that asset. So this is the chapter, it's about depreciation and amortization of those assets that you capitalized it already, but you need to depreciate it every year. Okay, so let's see what options we have for depreciation. So that's what I just explained, what depreciation expense is depreciation of those capitalized assets. We have real property, which is about like real estate. And we have one thing that never depreciates. What is that? Land. Land never depreciates. Land is always brand new. So it's very important. So if you buy a building which is sitting on a land, right? Building is not on the air, right? Building is sitting somewhere. So what do you depreciate? Do you depreciate the whole $1 million you paid for the building? No, you have to depreciate only the building portion of it, not the land. So how do you know what is land, what is the building? One way is to get an appraisal. So you have a land that you put in the land as a capitalization, but you never depreciate that. Then you have a building that you are going to depreciate later on. So you only depreciate the building, never depreciate the land. So that is a real property. Tangible property includes tangible property other than real estate, such as furniture, machinery, equipment, vehicles. Those are all tangible properties. So real properties are building, apartment buildings, manufacturing factories, plants, warehouses, land. That's real property. Tangible property is something that is not real, like furniture, machinery, equipment, vehicles. Okay. So depreciation will continue for the entire time that the taxpayer owns the property. Make sense? So every property has a useful life estimated by IRS. By IRS, it's estimated like 5 years life, 3 years life, 7 years life. So you're gonna follow that category. In a bookkeeping purpose, you can estimate it yourself. but for the tax purposes, you follow the IRS provided tables and categories. For example, compute 2022 depreciation expense on a building placed in service in 2014. The taxpayers use the rules that apply to property placed in service in 2014. So kind of, you need to look at that year, what's going on. If there's a specific rule, you have to follow that rule for that specific asset that you put in that specific year. Some rules are overall general, but I cannot just say, oh, this is 100% it is, and it's not gonna change. That's the bad thing about tax. By the time you learn something, they're gonna change it. Yes.
So if you owned a business right now and you bought a property or a building that was built in 1999, you would have to go back to the 1999.
No. Whenever you buy it,
oh, okay.
that year is the year that you follow the rule for that year. That is the moment you start depreciation. You see, it says placed in service. Placed in service, what year is that? Did you place in service in 2022 or 2023? Makes sense? Sometimes you buy something, but you don't put place in service because it's not ready, or you are not ready. But then you place in service the year after that. So that will be your place in service year.
So how would you handle it in the taxes for the year, the purchase, if you're not doing the depreciation?
You purchased it, but you don't put in, let's say in 2023, you don't put it in place in service, that's fine, then don't depreciate it. But then in, let's say January 1st of 2024, you put that in service, that's the date you start putting in service. But no, most of the times you buy an asset, you put it in service anyway, right? So that's normal condition. But again, if you are not going to put it in service for some reason and hold on to it for, let's say, end of year and then put it in service, then that's it. That's what it is. You start that as a date of putting in service. Okay, let's see. So let's read at this example. Sole proprietor deduct depreciation expense on their business property on Schedule C. Depreciation expense taken on rental property is reported on Schedule E. So if you have a rental property, that will be reported in Schedule E, not C or anywhere else. But if you have a business property, then obviously you depreciate that in Schedule C. Okay, let's go to some examples of where we will see. Okay, we have a bonus which came up in Congress. We call it bonus depreciation for purchase of new personal property used for business or investment purchased after September 10 of 2001 and placed in service by December 31st of 2004. So taxpayers were required to deduct bonus depreciation for all eligible purchases unless they made an election not to take it. So bonus depreciation is an election. You don't have to take it. You have to say, I elect to use that, or I elect not to use it. After deducting bonus depreciation from the cost of property, taxpayers depreciated the remaining cost known as makers. Makers means modified accelerated cost recovery system. Modified accelerated cost recovery system. So the remaining cost known as makers basis using the makers rule presented in section 60202 for property placed in service between September 11 of 2001 and May of 2003, the bonus depreciation percentage was 30% of the cost of property. So government gave that option to depreciate 30%. immediately, right away. Remember I said if you have an asset that you use it for a long time, you capitalize it and you don't expense it right away. So bonus depreciation is giving you an option to expense it right away. Just like utility expense, just like advertisement expense. But how much? It says if you did that in September of 2001 to 2003, that was 30%. After May of 2003, the percentage increased to 50%. So bonus depreciation 50%. So far so good. Until 2018, purchase of new property with a recovery period of 20 years or less were eligible for 50% bonus depreciation, which is good, right? Between 2003 up to 2018 was 50%. The bonus percentage rate now is increased to 100% for property acquired and placed in service after September 27th of 2017 and before January 1st of 2023. So up to that, before January 1st of 2023, it was 100% bonus depreciation. Used property, films, television shows, theatrical productions are also eligible for bonus depreciation. Bonus depreciation is claimed on Form 4562. So for 2003, bonus depreciation, I don't know what's gonna happen right now. We might Google it, but still IRS is not telling us 100% what's gonna happen. We might Google it and we will see. Let's see what's gonna happen. Bonus depreciation 2023. Let's see what we have. In 2023, businesses can write off up to 80% of purchase price of an asset placed into service in the calendar year, and then depreciate the remaining 20% cost of property over the course of several years. Below is the full bonus depreciation phase-out schedule. 2023, 80%. So that's what I have right now, 80%, but it's not from IRS website. It might be, looks like right now it shows 80%. Yeah, over there I see also 80%. Okay, so IRS will publish that anyway, but up to January of 2023, January 1st of 2023, it was 100% bonus depreciation, and that was an option. Again, is you don't have to take it. Why do you think someone will take bonus depreciation? If I have a business and I have a lot of income this year, right? Let's say in 2022, I have a lot of income. And because of that lot of income, I have to pay a lot of taxes, right? And I bought a equipment or machinery or vehicle, and I choose to use 100% bonus depreciation. Why? Because if I do that, I will reduce my taxable income significantly lower, and I will pay less income tax. And why do I like to do that? Because I think I have a lot of income in 2022, and it's not gonna happen again. In 2023, my income will go back to normal again. So I did very good in 2022, and for some reason, God bless, right? I have a lot of income, and bonus depreciation will help me to pay less taxes. But if my business is a normal business, I am making normal income every year, right? Not a specific huge income all of a sudden. And if I'm making a normal income every year, I'm not gonna use bonus depreciation. I'm gonna not elect that bonus depreciation because I want depreciation expense a little bit every year so I can use it for my, towards my income and reduce my taxable income. So it depends on the business. You have to look, is it good to use the 100% bonus depreciation in 1 year, or it's not a good idea? And looks like in starting 2023, it's gonna be 80%. Yes.
I stand as a section 179.
No, we are not there yet. Okay, so step one is bonus depreciation. Either you elect or you not elect. Got it? Hold on to that, then we go further down and you will see the other options coming up. But your first option is bonus depreciation. On August 1st of 2022, Victor paid $20,000 for new personal property to be used in his business. Very good. Victor deducts $20,000, which is 100% bonus depreciation for year 22 in the same year. And why he does that? Because he believes he has a lot of income in 2022, and this is a good option for him. And he believes in 2023, 24, 25, he's not going to be that lucky for making that much money. So it's better to right now take advantage of this as much as possible. Same facts, except that Victor purchased used personal property in August of 2017, but did not place the property in service until 2020. Victor does not deduct bonus depreciation in 2020 because bonus depreciation can only be claimed on used property that is acquired after September 27 of 2017. So if you purchase that before September of 2017, let's say in August of 2017, then the bonus depreciation will not be available to you. Okay. And that September of 2017, what's going on? That was when I believe Trump was elected, something like that. And they came up with this new rule, and that was the day I believe the rule was approved or something. Since originally enacted in 2001, bonus depreciation has only been allowed to expire in 2015 and 16. In 2018, Congress increased bonus depreciation to 100% for property acquired and placed in service after September of 2017. So for some reason, they choose that date. I don't know what the reason was specifically at this moment, but even they did that in 2018, but they started it from that date and before January 1st of 2023. The rate phased down 20% per year beginning in 2023. So in 2023, 20% we are down, right? From 100% to 80. That means in 2024, we go another 20% down. And it looks like we're going to continue that till it gets eliminated. However, the laws are likely to change again. So don't count on that. So whatever I say doesn't mean it's true. They can't. Even in the middle of tax season, let's say in February, which everyone thinks, okay, everything is over now. No one gonna change anything for now till next year. In the middle of February or March, they change the rule. And some people already filed taxes based on the old rule. And now they changed it. That happens, I believe, in 2022. It was crazy. So some people realize that, you know what? We need to amend our tax return. They just changed it in the middle of tax season. You can't do that, right? But guess what? They can. So, welcome. Land of possibilities, right? They can do everything. Here we go. Makers. So makers was what? Remember that word. Modified accelerated cost recovery system. And it says accelerated. That means you're gonna use fast depreciation, not straight line depreciation, right? Make sense? What is straight line depreciation? Straight line depreciation is, if you like to write it down, is total cost, including shipping, delivery, and testing of your equipment, whatever asset you purchased. Total cost minus salvage value, which for tax purposes you use 0. But for bookkeeping, you might estimate a salvage value, but for tax purposes, you say 0. So total cost minus salvage value, which is 0 in tax, divided by useful life. So who's going to tell you what is the useful life? IRS will tell you. Here says 3, 5, 7, 10, or 15 years useful life. It's provided to you. Depends what you are buying. You have to look at what it is and where you can put this in that specific time period. Okay, and then that gives you annual depreciation straight line. But here says makers accelerated, modified accelerated. That means it's faster depreciation. However, I can tell you right now that besides modified accelerated depreciation, makers includes an option that says straight line depreciation. So who wants accelerated depreciation? Let's say you buy a Cadillac. Cadillac depreciates very fast. It's a luxury car. Depreciates very fast. So modified accelerated cost recovery, that's a good option, right? But if you buy a Toyota pickup truck, then Toyota pickup truck doesn't lose value that fast. So you might want to use makers, but straight line makers as an option, straight line depreciation. So depends on your business, depends on your asset. You might choose accelerated option or straight line option. So makers includes straight line option if you want. Like in my business, because the income was almost same thing every year, if I had a equipment, I don't like to use accelerated, because if I use it, then 3 years down the road, I don't have anything to depreciate and I have to pay a lot of taxes. So I try to use always straight line makers, because that will give me a systematic depreciation expense every year, which I'm going to use it for my business. So it depends what business you are in. Yes.
So is makers simply the classification system of how long depreciation is going to be?
Yes.
So everybody's using makers. It's whether you use the
for tax purposes. For tax purposes.
Tax purposes, not for bookkeeping.
For bookkeeping, you might choose another way with a salvage value, and then it will be different than your tax. But in my case, to make it both same, in my bookkeeping, I choose 0 salvage value, same as tax, and I use the same estimated useful life, which tax is telling me to do. So that way, my tax expenses and my bookkeeping expenses are kind of same thing. Questions? How do you calculate that? Hold on, buckle up. I told you this is a harder chapter, so here we go. So let's go. First thing, to calculate depreciation expense using makers, taxpayers multiply the maker's basis. So what is your basis? If you use your bonus depreciation, guess what? You have no basis. Your basis is 0. That means the next year, if you sell your equipment, whatever you sell, it's all capital gain, because you depreciate it using full 100% bonus depreciation. So assuming you don't use the 100% bonus depreciation, then you multiply the maker's basis of the property by percentage taken from the IRS provided tables. So they give you tables. Under makers, personal property is assigned a regular recovery period of 3, 5, 7, 10, or even 15 years, regardless of its actual useful life. Make sense? So you have to follow these given options: 3, 5, 7, 10, or 15. So we don't have 4 years option. Do you see here it says 4-year option? Do you see anything says 6, 7, 8? No. This is what we have for them. So makers assigns the more common properties a 5-year or 7-year recovery period. So the 5-year property class includes what? 5 years. Write it down. Vehicles, office equipment, cell phones. Those are all 5 years. So automobile 5 years, office equipment 5 years, cell phones 5 years. 5 years office equipment includes copiers, fax machines, computers, printers, and like that. The 7-year property class includes office furniture and equipment not described above. So if you have office furniture like desk, it's 7 years property. But on your desk, you have a computer. The computer is 5 years property. You have a car also on the parking lot, that's also 5 years property. Makers use 200% declining balance method. 200%, we call it in, if you took bookkeeping courses with me, we call it double declining balance method. Double declining balance method. Double declining balance method is like this. Let me make it easy for you. So let's use a calculator. See how I'm doing it so you get the idea. Let's say you buy an equipment for $100,000. So what is your basis? 100,000. So you say 100,000, which is 100% of your equipment, divided by, let's say this is a vehicle, 5 years life per IRS. So you divide that by 5 equals 20%. So you have 20%. 20%, but because this is double declining or so-called 200%. You see here it says 200%. 200%, that means times 2, right? So 20% times 2 equals 40%. So you are declining this using 40% rate of depreciation. Very fast. 200%. That means whatever is the straight line. What is straight line? Let's do it again. If I delete the whole thing, how do I delete? Okay, so here you say 100%, which is one. Right? I don't want to use that. Let's use 100%. So let's use number. 100% of your equipment divided by 5 years useful life equals 20%. 20% is straight line depreciation, but you want to do 200% accelerated depreciation. You multiply that by 2. If it says 150% declining, you see here it says 150%, then you multiply that by 1.5. So let's do it again. So you say 100%, not times, divided by 5 years life equals 20. 20 times, instead of times 2, you say times 1.5, which is 150%. You see that 150%? And that will be equals to 30. So that's 30% will be the rate of the depreciation. So far, so good? Yes? Okay, but it's gonna get a little bit complicated than that. Now, you will see probably in next page. Under tax rule, it says, when did you buy this? Normally, in most cases, we assume you put this in service in the middle of the year. Got it? So, you remember I said double declining is 100% divided by 5 years life, gives you 20%, 20% times 2, double declining, that's 40%, right? So if you're gonna use this for half of the year, Then what is half of the 40%? 20%. So in year one, even though you use it for the whole year, but IRS is assuming you put it in the middle of the year. That means half of the depreciation, half of 40% is 20%. So year one will be 20%. You're going to see in the table later on, but then I will refer you back to whatever I'm saying right now. So 150% is slower accelerated depreciation. 200% is very fast, double declining balance method is 200%. But 150% is slower. The 150% declining balance method is used for 15 years property. So for 3, 5, 7, and 10 years property, you use double declining, which is 200%. But for 15 years property, you use 150% double declining. It's not 150% declining, not double declining, 150% declining. Okay. Makers switches to the straight line method when a straight line depreciation yields a greater depreciation. So you will see in a moment, maybe 2 years, 3 years down the road, if the regular straight line depreciation becomes a bigger depreciation expense, then all of a sudden makers double declining will switch to straight line depreciation. How do you manage all this? Guess what? Your software will do it for you. I'm trying to teach you, but again, don't panic because your software will do it. All you need to tell to your software, when did you put this equipment in service? How much was the cost? Do you want to use bonus depreciation? Do you want to use Section 179? Yes or no? And then the software will take care of this for you every year, and it will carry forward year after year for the next tax return and the next tax return and the next tax return, and it will provide you a schedule of depreciation as a worksheet extra. So everything will software do it for you, but here we are trying to just learn it as a form of.
Usually check like one box and see what it looks like, and then do it the other way to see.
No, you have to,
You have to know.
you have to learn this to understand which option is better for your client, because you are preparing a tax return, right? So based on the client, his business, income level, you have to decide when you are choosing those boxes.
I have no idea how to decide. Is there stuff I don't get it?
I'll give you an example again. One more time. I just gave you, but I give you the same example again. Let's say this year, I hit the jackpot. I made a lot of money. Crazy amount of income. And I bought a car. You are my tax preparer. You say, okay, how is your income this year? I said, oh my God, I made so much money this year. Do you think next year you're going to make that amount of money? No, it was just this year. It was a very good deal. We got a client. We made a lot of money. That's it, but not next year, I don't think. Okay, then you have to think. As a tax preparer, you say, okay, if you made that much money this year and you're not going to do it again and again and again, then it's better to use bonus depreciation to depreciate the car that you purchased this year using bonus depreciation, so we can have a lot of depreciation expense, lower income, paying less income tax. And your client will appreciate your professional, comments that you make about that thing. So you have to think professionally for your client. If the client says, no, I have a normal income and every year I'm gonna save the same income, then you say, you know what, I'm not gonna use bonus depreciation for you. To be honest, I'm not gonna even use 200% declining balance method for you. I'm gonna use maker's straight line. Got it? So you have to decide based on the business, based on the income, based on the situation, which of these options is better. You choose that, and as soon as you choose it, you go with that. Yes.
So with makers, there's three options: the straight line, the accelerated, and the 200 declining.
Accelerate, as soon as you say accelerated, then you have to say, okay, is it 3, 5, 7, 10 years property? Yes, then 200% double declining is your option. Or straight line. Makers, but straight line makers. So you have to choose which one. And plus you have to choose, do you want bonus or no? Elect bonus or not elect bonus? After bonus, it's section 179, which we're gonna see. After bonus, you choose yes or no. Let's say you say no. Then you have to decide. But here it says straight line method will be chosen the moment that the software realizes that using straight line depreciation will provide higher depreciation expense. That happens normally 2-3 years down the road. After using double declining, 2-3 years down the road, it might come to the moment that straight line depreciation will provide a little bit higher than double declining. And why is that? Do you know? Because double declining, as it says double, that means in year 1, year 2, you have huge depreciation expense, fast, double declining. But in year 3, 4, 5, all of a sudden it becomes tiny amount of depreciation. Make sense? That's why you have to look. If you need a huge depreciation, not too huge, because if it's too huge, then you choose bonus depreciation, right? But assuming you don't want that huge depreciation, but a little bit higher than normal, then you use double declining, which in year 1 and 2 will provide you higher depreciation. And why do you choose that? Because you got a new client that will be a good client for this year, next year too, but after that, that client is gone. So then you make a strategic decision to choose double declining instead of straight line makers, because this year and next year you're gonna have this client. After that, not gonna have this client, so you're not gonna have a lot of income. If you don't have a lot of income, guess what? You don't need that much depreciation. So depreciation and how you choose it is a tax planning. Make sense? And you have to choose it right and correctly so you can help your client. Makers ignore salvage value. One more time, I told you already, salvage value is ignored under IRS tax rule. Instead, taxpayers multiply the percentage from the table by the property of maker's basis to compute maker's deduction. We're gonna see an example. Computing maker's basis begins with the unadjusted basis in the property, which is the taxpayer's total cost of property for use at its operating location. So for makers, you use always what? Unadjusted basis. If you learned, again, bookkeeping with me, you know that already. Under double declining, you always use your original cost multiply with the ratio. Original cost multiply with ratio. Yes, in year 2, your original cost is still original cost. Your book value is different, but your original cost is always the original cost. So you use that original cost multiply with the ratio. It includes the purchase price, original cost, sales tax, delivery, installation, testing, all of those combined to make your property ready for intended use. That is your original cost. However, Section 179 preempts makers. That means Section 179 comes before makers. Section 179 comes after bonus, but before makers. So what is that? Any section 179 expense or bonus depreciation taken in the first year is subtracted from the unadjusted basis to compute the taxpayer's maker's basis. So maker's basis is bonus depreciation, if anything left, minus section 179. If anything left, now you have maker's basis. So it's the third level of category of calculation that becomes your maker's basis. We will see examples, okay? Don't worry.
So basically, if you do 100% bonus depreciation, you can't do makers.
If you do 100% bonus depreciation, you cannot do even section 179. If you cannot do section 179, definitely you have nothing to do for makers. It's all gone. It's all depreciated. In 2022, bonus depreciation is 100%, right? But in year 2023, minus, it goes 20% down, so it's 80%. So if you use bonus depreciation in year 2023, still you have 20% left. 20% that you might choose to use section 179 or just choose makers. So the unadjusted basis of non-business property that the taxpayers converts to business or investment use equals to lesser of the taxpayer's adjusted basis in the property or its fair market value on the conversion date. Lesser of, okay? Very important. So if someone brings his personal car into business all of a sudden, then you go with taxpayers adjusted basis or fair market value, whichever is lower. Special rules also apply to property acquired by exchange, gift, or inheritance. These rules are discussed in chapter 10. Okay. Averaging conventions. Two averaging conventions determine the date on which taxpayers can begin depreciating personal property. These two conventions are either half-year convention. Remember I said half-year convention? That means if you buy a property, IRS, assuming you started from the middle of the year, that's half-year convention. And mid-quarter convention. The half-year convention applies when at least 60% of the basis of personal property placed in the service during the year is placed in service during the first 9 months. So at least 60% of the properties that you purchased, like machinery, equipment, building, whatever, the cost, 60% of that, if it's placed in service during the first 9 months of the year, then you use half-year convention for all of them. Half-year convention for all of them. The mid-year quarter convention applies when more than 40% of the basis of personal property placed in service during the year is placed in service during the last 3 months of the year. Then you apply mid-quarter convention. So if it's more than 40% put in the service in the last 3 months, then you use mid-quarter convention. Mid-quarter convention means they assume you put this in the service in the middle of the quarter that you purchased. So middle of quarter of the last 3 months is mid-November, November 15th. Yeah, mid-quarter for the first quarter is February 15th. Make sense? So 3 months, 3 months, 3 months, 3 months. First 3 months in the middle is February. Next 3 months is February, March, April, May, June. So second quarter is mid-May. Third quarter is June, July, August, September, mid-August. Mid-August is the third quarter. Middle of third quarter is August 15th. But why do they do this? Because some companies, they are waiting till last 3 months of the year to buy equipment. And IRS says, okay, if you are going to wait till last 3 months to put your equipment and buy equipment and put them in service, then you have to use mid-quarter option. Why? Because you put more than 40% of the properties that you purchased in service right in the last 3 months. And IRS says, I don't want you to use half-year convention anymore. And the reason is because some people are taking advantage of half-year convention, and IRS says, no, don't do that. But if you buy at least 60% of basis of all your properties in the year, in the first 9 months, then you use half-year convention, which is hopefully most of the times that's the case. So when at least 60% of properties placed in service during the year is placed in service during the first 9 months, then you use half-year convention. When using the half-year convention, the actual date on which personal property is placed in service is ignored. That means you may put the property in January 1st, but still you use half-year convention. That means you put it in the middle of the year in service. So instead, the half-year convention assumes the taxpayers place the personal property in service halfway through the year. Make sense? The half-year convention also assumes the taxpayers dispose, that means sell, property halfway through the tax year. Let's say you sold it in December or November of the, 2025. IRS says you sold it in the middle of the year of 2025. So when you put it in service, it says you put it in the middle of the year. When you sold it, it says you sold it in the middle of the year. Why is that? Because assuming here is 5 years property. So you have 5 fingers and every finger is assuming 5 years property. So if you use half-year convention, then year 1, you are using half year in year 1. Year 2, 3, 4, 5, you are using full year convention. So, full year depreciation. So how many years is this? It is 4 years and half, right? That means in year 6, when you are doing depreciation, in year 6, you are using half year depreciation. So half year in year 1, half year in year 6, and in between, it's all full year depreciation. Make sense? Okay. Now watch. Remember, I was using a calculator. There's a calculator. Huh? Yeah. So one more time. When you put equipment in the depreciation, you depreciate 100% of that equipment, total cost, 100%, divided by, let's say, 5 years life. You see that 5 years? So here is divided by 5, equals 20%, right? 20% times double declining, 200%. So 20% times double declining, which is times 2, equals 40%, right? But IRS says you have to use half-year convention, right? So what is half of 40%? Half of 40% divided by half is 20%. This 20% is that 20%. Got it? Make sense? Now you know why this is 20% here. It is double declining, which is 40%, but because it's half year convention, so half of 40% is 20%. So year one, you use 20%. So IRS is using double declining, the same thing that you learned in accounting and bookkeeping, but I just here prove you why this is 20%. And IRS says, because you might forgot or you never took accounting with me, so you might don't know how to do double declining, right? Most of you don't know, or you forgot if you took the course with me. IRS says, don't worry about it. I'm going to give you the percentage year already in the table. So all you need to do is just multiply your basis with these given percentages that I gave you in this table, and that will be double decline. Got it? So it makes your life easier. Now, IRS tells you what type of equipment you have. Let's say automobile and regular equipment, you use what? 5 years, right? Cell phones. If you have office furniture, what is that? Office furniture is 7 years, right? Automobile, computer, printer, fax, all those, cell phones, those are all 5 years. God bless, right? So ratios are also given. So all you need to do is just multiply. So when you want to use this table, you have to identify what type of equipment you have. Recovery period is 5 years or 7 years, and then use the ratios to multiply. So the year one percentage from figure reflects a half-year convention depreciation. Using 200% declining balance method, taxpayers should deduct 40% of the cost of 5 years property in the first year, but the point is half of 40% is just 20% because mid-year, half-year convention. So that's why you have 20%. Got it? Questions before we move on? Okay, you're good. So let's make an example. It makes our life easier. On March 2022, Caroline placed new 5 years property like a copy machine or printers or automobile costing $10,100 in service. She deducted 100% of this as bonus depreciation. So guess what? There's nothing else to depreciate. Gone. So you're done. And why you use that? Because Caroline said, this year I have a lot of income and I don't know what to do. My income tax will be crazy. And you as a taxpayer says, don't worry about it. I'm going to use bonus depreciation for you. And I'm going to put all these $10,100 as a bonus depreciation and bring your income down and pay less taxes legally. Right? That's tax planning. Except in the last year of the recovery period, when using the half-year convention, taxpayers multiply the maker's percentage from the table by 1.5. Okay, let's look at the example. Sorry, you will see. I told you about this. I told you already. What was that? I said in first year, you use half-year convention. Year 2, 3, 4, 5, you use full year convention. I mean, full depreciation. And year 6, when you sold it or you finish the depreciation, in year 6 is just half a year. So year 1, half year, 2, 3, 4, 5 is full year, year 6, half year. That combined, half plus 4 plus half is 5 years. That's 5 years of depreciation. April 10 of 2019, Kate placed in service 5-year property costing $10,000. She elects not to claim bonus depreciation and not to use Section 179. On November 30th of 2022, Kate sells the property. So how long is later? That's 2019. And in 2022, 2019, 20, 21, 22. Okay, under the half-year convention, the annual depreciation for the property is shown below. In 2019 is $2,000, which is $10,000 times 20%, half year convention. Agree? In year 20, it's 10,000 times 32% via using the table that IRS gave you. So it's just $3,200. In year 2021 is $10,000 times 19.2%. So that's 1920. In year 4, which is 2022, is $10,000 times 11.52, which IRS gave you that table, and multiply by half year convention because we sold it in 2022. Doesn't matter when you sell it in 2022. Doesn't matter. Still, IRS consider that as half year. Sold it in the middle of the year. That's why it's 1, 2. So total depreciation is $7,696. It doesn't matter when in 2022 Kate actually sells the property. The half year convention assumes that she sold the property in June 30th of 2022, half year convention. Make sense? So total depreciation is how much? $7,696. Now, if 10,000 original cost minus 7,696, how much is it?
2,304.
10,000 minus 7,696 equals 2,304. Now, if Kate sold this property, anything above 2,304, it's capital gain, long-term capital gain, because more than 1 year, it's long-term. So if she sold this property below 2,304, then it's long-term capital loss. Make sense?
And the person who bought it, their basis for that would be whatever.
Whatever the person who buys it, let's say the person buys it for $8,000. So, so this is the basis, 2,304. The person who buys it for $8,000, has $8,000 basis all over again. The whole thing that we did for Kate, we're gonna do for that new buyer. Buyer's tax preparer will do it as a used equipment purchased at this half year convention basis $8,000. For Kate has a capital gain because 2,304 minus $8,000 purchase selling price, it's 5,696 capital gain because Kate sold it for $8,000. So God bless, she has $5,696 long-term capital gain. Yes.
So for example, if we use the straight line for every year, $2,000,
If you use a straight line, will be $10,000 divided by 5 is 20%, right? 20% using mid-year convention, year 1 will be 10%. So 10,000 times 10%, year 1. Make sense? Yes? Why not? If you do double declining, is 100% divided by 5 is 20%. 20% times double declining is 20% times 2 is 40%. 40% for half year convention is 20%. Here is 20%.
I mean, you mean if even you choose straight line, you have to combine with double?
No, here. I'm doing straight line. Watch. Let me, yes, okay. $10,000, right? I want to do straight line, year 1. Straight line, year 1.
I mean, straight line have to combine with half years.
Of course. Half year convention is always half year convention. Again, if you buy 60% of your assets in the first 9 months, what are you going to use for every single asset? Half year convention, case closed. So if you use straight line, this is 100% of asset divided by 5 years life is 20%. So you're gonna use 20% in year one. But guess what? Year one is half year convention. So 20% divided by half, 10%. So year one is 10%. 10% of 10,000 is $1,000 depreciation. So if you use a straight line depreciation in year 2019, you would have $1,000 depreciation because it's half year convention. If you use accelerated makers, that's fine. That will be 20%. Actually, it's 40%, but because it's half year convention, half of 40% is 20%. 20% times 10,000 is $2,000 depreciation.
What?
Yes.
I don't understand where the rates are, sorry, maybe you said it, for straight line depreciation.
Straight line depreciation is like this, very easy. Let me teach you. You want to use straight line depreciation, the rates, you want to know the rate? Here.
Yeah.
100% of the equipment divided by useful life,
Yeah.
which is given by the IRS to you, divide by 5, equals 20% a year for 5 years.
Okay.
But IRS says, don't forget half year convention, right? So year one, are you going to use 20%? No, half year convention is half of that. So first year will be 20% divided by half, which is 10%. How about year two? 20%. How about year three? 20%. How about year four? 20%. How about year five? 20%. How about year six? Half of straight line, half of 20% is 10% again. So 10%, 20, 20, 20, 20 for 5 till on end of year 5, and then year 6 will be 10%. 10%, 4 times 20, and 10% again. Got it? Yes?
So you can only use, when you get the property that first year, it's always either half quarter or mid-quarter and nothing else.
Yeah. If you buy all your assets during the, not all, up to 60% at least, the first 9 months, then every single thing you buy in that year will be half year convention, case closed.
Why did they do that? I don't really, like, you would think it would be the second 9 months or something.
If you, second 9 months, what is second 9 months?
Well, after the first 3 months, like, why aren't they just doing it in the first 6 months? If you buy it within the first 6 months, you get a full year. If you buy it after 6 months.
IRS normally probably want to do something like that, but then IRS sees that people are taking advantage of this and trying to adjust their purchase to a moment that is more beneficial to them. And IRS says, no, wait. Looks like you are trying to play game again. Because the moment IRS losing that rules, people are starting to playing games. So in order to prevent playing games and playing smart, IRS says, okay, this is a rule. If you buy 60% of your assets first 9 months, you're gonna have for half year convention. Everyone, same rule, follow this.
Means if you only buy one big asset, say a car, and you bought it in October, you get a whole year's depreciation on
No, mid-quarter convention. If you buy your asset, you don't, let's say you buy nothing, or you buy at least 40% of your assets in the last 3 months, IRS says then, you know what? Everything is mid-quarter. That means if you bought it in January 10, one of your assets in January 10, it is mid-quarter, which is mid-quarter of first quarter. Make sense? Mid-quarter of first quarter.
What? How many, wait, I don't understand again. January 10 is.
Let's say you bought 5 pieces of assets, but most of those assets you bought the last 3 months of the year.
Okay,
Then IRS says, okay, then every asset
or even if you bought it on January 10th.
is gonna be mid-quarter. So if you buy in January, January is first quarter. What is the mid-quarter of first quarter? February 15th. If you bought it in the second quarter, the second asset in the second quarter, that will be the mid-quarter of the second quarter. The last 3 assets you purchased in the last quarter, that's why it's more than 40% in the last quarter, right? So if the last 3 assets you bought it in the last quarter of the year, those last 3 will be mid-quarter of fourth quarter. Make sense? Mid-quarter of fourth quarter, it is November 15th.
So every individual,
Every single asset will be
they go by themselves or together?
not all together, no. Depends when you
One by
buy.
one, right?
When did you buy it in quarter 1, quarter 2, quarter 3, or quarter 4? If you bought it in quarter 1, it will be mid-quarter 1. If you bought it in quarter 2, it will be mid-quarter of quarter 2. Make sense? Okay, here is the mid-quarter convention. I already explained that. But probably it's better if we use let's see an example. It's easier. Okay, here is the table first. You see, it says, let's say you bought your equipment more than 40% in the last quarter. So you all of a sudden you have to use mid-quarter convention, right? Okay. Is it a 5-year property, let's say? Okay. When did you buy? In the first quarter? If you bought it in the first quarter and using mid-quarter convention, then you use 35% rate. Did you buy it in second quarter? Then you go with the mid-quarter of second quarter. That will be using 26% ratio.
Maybe 25.
If you, what is that?
Wouldn't it be, you're saying if you bought it in mid-quarter of the second quarter, wouldn't that be 25? Because that too, that you're pointing at, that's the second year. That's not. the
This
quarter.
is the second year.
Right.
Yeah.
Okay.
Sorry, this is the second year. Same scenario, same equipment. In year 1, you use 35% because it's 5-year property, let's say computer. And then year 2, you use 26% and all these ratios given. But let's say you bought it in second quarter. The computer, you bought it in second quarter. Then it will be 25% for year 1 and then 30%, 18, and so on and so forth. Let's say you bought that computer in third quarter, and its computer is 5 years property. So you for year 1 is 15%, year 2 34%, 20%, 12%, and so on and so forth. And if you bought that computer in fourth quarter, it will be 5 years property, and you're gonna use 5% ratio. Make sense? So the table is given. All you need to do is just understand the table, but you're not going to do it manually. You just need to enter this into your software, that which quarter you are using, mid-quarter convention or half-year convention, and then do it based on that.
How
So
would you use, I mean, how would you choose, like, which one is better than the other? Like, why would you use mid-quarter as opposed to half year?
half year. Okay. So here is the answer. The government now imposes a mid-quarter convention on all personal property placed in service during the year for the taxpayers that purchase over, not 40, but over 40% of the depreciable personal property or real non-real estate during the last quarter of the year. So if your company chooses to buy more than 40% of the all properties at the last quarter, they automatically forced to use what? Mid-quarter convention.
So
Automatically forced.
is that for all? Okay, so let me ask you, if a company started and they bought something in January, some things in November, do they have to use the same, the same thing for
Mid-quarter.
all the things that's purchased, or just the things that was purchased? And things?
Because the one that they bought in first quarter is less expensive, and the one that they bought in last quarter is more expensive, let's say. That means more than 40% of the asset was purchased in the last quarter. All of a sudden, every asset that you purchase in that year becomes mid-quarter convention by force. There is no more half-year convention. Gone. Half-year convention is gone. Because you choose to buy that expensive property instead of the first 9 months, you decided to buy it in the last quarter. If you push that thing to the last quarter, IRS says then everything is mid-quarter convention. But if you choose to buy that in September, and that's at least 60% of your asset purchased is in first 9 months, then you use half-year convention. Mid-quarter convention is out of question. You don't use it. It's not forced.
What's the benefit of purchasing the property late and then trying to get more depreciation on it?
Okay, IRS says, I want you to spend your money to buy car, printer, copy machine, office furniture, those type of things, as early as possible, instead of waiting till Christmas time. Make sense? To push your purchases into the beginning of the year. And that's a good reason, because normally, let's say in first quarter of every year, the business is overall, economy is slow, right? Economy is very good in Christmas time. They don't really need you to spend money on Christmas time to buy a big equipment and the $100,000 automobile and truck and whatever else. They like you to spend this money early, and do it early. And if you do that in the first 9 months, at least 60%, then you will use mid-year convention. And here is the tape. All you need to do, assuming you purchased more than 40% in the last quarter, then you automatically will be entered into mid-quarter convention. No more mid-year convention. You will be in mid-quarter, and you're going to use this table to figure out how much you are going to depreciate. So here is an example. And then we stop class at this point. In March 2020, Ed placed in service 7 years property that cost $20,000. Ed elected out of bonus depreciation, so no more bonus, okay? Ed sold the property in June 2022. So that was 2020, and then sold in June. June is the second quarter, right? January, February, March, April, May, June. Yes, in second quarter. Under the mid-quarter convention, depreciation taken on the property is as follows. In 2020, it is 7 years property using mid-quarter. So let's go up. 7 years property. They bought it in March, which is mid-quarter, okay? 7 years property, that line, that line. You see that 25 right there? That. 7 years property, year one is 25%. So 25% of $20,000 is $5,000 depreciation. Year two, 21.43%. 7 years property, second year. And that is mid-quarter one, okay? Mid-quarter one. Third year is 15.31, which is that. But in third year, it is sold in the second quarter. So that means you sold in the middle of second quarter. Make sense? By force, that's what it is, middle of second quarter. So 4.5 out of 12, that's the middle of the second quarter. Times, that's a ratio. So 20,000 times 15.31% times this ratio of 4.5 out of 12, that gives you 1,148. So total depreciation for this equipment will be $10,434. How much it is the original cost? 20. How much is the accumulated depreciation? 10,434. What is the net book value? Net book value is 20,000 minus 10,434 equals 9,566 net book value. If he sells it above 9,566, it will be capital gain. If he sells it below 956, it will be capital loss, long term. I'm just going to read what is in here. The maker's first quarter percentages apply since Ed placed the property in service during the first quarter. Yes, we know that, right? Although Ed actually sold the property in June, the property is sold, is deemed to be sold halfway through the second quarter, which is May 15th. Got it? So far, so good. Ed multiplies the year three maker's percentage by 4.5 out of 12. 12 months. 4.5 months out of 12 months to reflect the property's depreciation from January through May 15th. Notice that Ed used the percentage for 7 years property placed in service in the first quarter for all years that he depreciates the property. At the date of sale, Ed adjusted basis in the property is 12,084. At the date of sale, why is 7,000? I don't understand why is 12,084. $7,000 accumulated depreciation. I don't know why is that.
Shouldn't it be 20,000 minus 10,434?
Yes, that's what I put in the calculator, right?
Yeah.
20,000 minus 10,434. So this is, I think this is a typo or something. So this is wrong. Mine is better. Yeah. Anyway, so we learned up to this mid-quarter and half-year convention. We continue next time. It's a complicated chapter, honestly. You see, I'm trying to explain and it's very hard to explain. But if you read it slowly, it will get easier to learn. So I suggest every chapter that we cover, always read it before we meet, so we have less challenge here. So it's easier to go over it. We will do it next time, hopefully the rest of it as much as we can, okay? But I suggest read the chapter definitely. See you next time.